Hey guys, Steve Ferguson, the loan officer, Thrive Mortgage. Thanks for tuning in today. Today we're going to talk about mortgage insurance. Now, this makes me look smart. That's why I have glasses on. We're going to have an educational seminar here about mortgage insurance. Do you want it? Do you need it? Can you remove it? This is hurting my nose. Okay. We're going seriousness here, right, guys? So I'm going to lean back. We're going to talk about this for a second. Let's just have a basic conversation. Number one, the definition of mortgage insurance sounds like insurance, right? That's because it is. And so mortgage insurance is placed on a mortgage generally when you borrow more than 80% of the loan size. So here's what this means. If you put down less than 20% down, then you're probably going to have mortgage insurance. Okay. What mortgage insurance does is it protects the lender in case you default. Okay. So it is truly a mortgage insurance policy the lender pulls out on the loan when you put less than 20% down, that if for some reason you default on your mortgage, and default means like a foreclosure, then that insurance policy pays the lender back a portion of what they lost. So does it protect you? No, it does not protect you. Now, are there benefits to having mortgage insurance? Some, right? Number one, main benefit is you get to borrow higher loan to values. That means you can borrow more money and put less money down to buy your home. So for example, FHA is a great loan product, only 3.5% down payment. Assuming you have the credit score to qualify for that product, there is mortgage insurance on that program. And there's mortgage insurance for the life of the loan right now in FHA. So unless you refinance or sell or pay it off, that mortgage insurance is always going to be there. On a conventional loan, which is just the generic vanilla loan style, if you borrow more than 80% to buy that home, let's just assume you put 10% down and you do a 90% loan, you're going to have a mortgage insurance on it, but that mortgage insurance can be removed after a certain period of time, assuming you pay down your principal enough to equal approximately 78% of the original loan. So, pros and cons of mortgage insurance. Pro number one, low down payment. Okay. Pro number two, you can see better interest rates sometimes when there's mortgage insurance involved. I know that sounds weird, but remember, a lender is protected when you have mortgage insurance. So there can be a little bit of rate incentives associated with having mortgage insurance. Number three, there's a lot of first-time homebuyer programs for low down payment borrowers, again, that are really built around mortgage insurance. That's really the three main reasons to have mortgage insurance, okay? However, there are ways to get around mortgage insurance, right? Nobody wants to spend extra money they don't have to spend. I don't blame you. I wouldn't either. So let's talk about some ways to get around mortgage insurance, also known as PMI. Number one, the easiest way is put down at least 20% on your mortgage. So if you're buying a home, it's a conventional style loan, 20% down, you don't have mortgage insurance. Number two, use a combo loan. So combo liens means you have a first lien. Let's just assume that first lien is 80%. And then you have a second lien, which is a second mortgage behind the first lien, which is 10%. Then you only put down 10% and you don't have mortgage insurance because the mortgage insurance is based on the first mortgage, not the combination of both mortgages. So if you do a combo loan, you can get rid of mortgage insurance and don't have to worry about paying that every single month. Option three is you use a program that does not require mortgage insurance. So a lot of non-QM loans. A non-QM loan is a loan that doesn't fit traditional lending guidelines, but still offer you some really good products with low down payments. So those programs don't have mortgage insurance at all. You can also do what's called lender paid mortgage insurance, which means the lender can pay a bulk payment on your behalf and get rid of mortgage insurance. And there's also special programs that just simply don't have mortgage insurance because they're designed for a specific genre of borrowers, and there's certain qualifying requirements that you have to have in order to have that type of product. So there are solutions to get rid of mortgage insurance. What I want you guys to have is a clear understanding that mortgage insurance exists for a reason. There's pros and cons to each one, but there's ways to get around it every time. So from a first-time homebuyer standpoint, or from a current homebuyer who's upgrading, or whatever it may be, know what you're getting before you buy it. That's the goal, right? Know what you're signing for. know what this is going to do to your mortgage payment, and what would it look like if I got rid of this? Even if my rates are higher, is my payment lower? Probably so. Also important to remember that on conventional loans right now, mortgage insurance is score-based. So the higher the credit score you have, the lower your mortgage insurance is going to be. So things to think about, right? Well, guys, I hope that kind of gives you a good explanation of mortgage insurance. It's a little bit complicated, but it's definitely a necessary part of the mortgage process. And you want to work with a loan officer who knows how to get around those things, or at least educate you on what you're getting to as well. Love to visit with you. Please subscribe to my channel. I would love to get you guys to subscribe. These videos take time and I want to educate you, but I would love to get as many subscribers as I can. And make sure you watch my other videos. There's some great videos out there. So thanks for your time, guys. Have a great day. And again, this is Steve Ferguson, the loan officer, Thrive Mortgage. Talk to you later. Bye-bye.